But yeah,
Michael, you
yes,
actually made it to Nashville.
I did. I did. You know, I was told though by like several people already that if I had come last week, that it was like covered in
Yeah,
snow.
it was. We got dumped with 9 inches of snow, so that wasn't fun. So your timing is great. Look
I
at
did. Do you guys have snow removal? You guys have like all the snow removal
no,
stuff?
we let nature do its thing.
You do? Oh my gosh. It's kind of like, you know, well, in Boston, obviously there's snow plows and there's ice trucks and there's everything else in between. And in Arizona, like even if it rains a lot, people are freaking out. There's nowhere for the water to rush and go, and it tends to sit,
Yeah.
and people struggle to drive.
Yeah, we came to a bit of a standstill last week with the snow, but we made it through.
You did. Hey, you also made it back from your trip from India.
Yes,
How was
it
that?
was amazing. I went for my niece's wedding and it was an incredible trip.
Yeah,
And you made it back from Japan.
I did. I'm supposed to say something in Japanese, right?
You should.
I did, you know, and for those that know, I've been studying Japanese now for 4.5 months or so. Yeah, so like Nihongo ga wakarimasu, you know, I understand Skoshi, a little bit of Japanese. I'm working on it. It's a work in progress. So do not send me these like, you know, things of, you know, Japanese. I still can't read the text, but I can speak some. But the thing that's a real killer is that travel. My goodness, it was like a 16-hour time difference for me. It's something monstrous.
Yeah, it was almost a 12-hour time difference for me. How long was the flight for you?
Why? Are you just saying that? You're just saying that.
I want
You want
that.
that? Okay, it was awful. It was, we left the hotel, which I know is not your question, but I'll answer it. We left the hotel at 8 o'clock in the morning in Japan to take the subway to the Shinkansen, the bullet train, to, you know, to the airport, to the Narita airport, where we were there at the airport when the earthquake hit.
That it's as dramatic as it gets.
It was. I wish I could say it wasn't. It really wasn't. It wasn't like everyone was falling over, but it was that happened. And then the entirety from flight to flight, there were 3 flights. By the time we get back, it was 28 hours of travel. Yeah,
Yeah,
yeah.
my thankfully no the earthquakes for me through the travel, but it does, from home to home, it does take me good 30 plus hours to do. My flight this time around I was flying direct from New York to Delhi, and it was a 17-hour straight shot. It was not fun.
I know you have to like really want to go. We need to start our market outlook.
Yes,
We have, by the way, I think we've consolidated this thing.
a
Yeah.
lot. Yes.
So again, so for those of you who are listening to us or watching us live, there's an element of this that's also kind of like they call the AMA or Ask Me Anything component. So Josh is he's there and he's ready. So for your questions, as you have them, do find the chat button on your Zoom link and hit him up with questions. We did get some questions, so thank you for sending those. We're going to try to weave some of those throughout the presentation to make sure your questions get answered. But I do want this to make sure that each of you have an element where you maximize this time together so that you leave with a greater understanding of what's going on in the world, economically speaking, financially speaking, and ultimately your portfolio. That's the goal.
Yeah, that's absolutely the goal. Do you also want to maybe give a quick recap before we start for anyone who's joining us for the first time on what to expect in the next hour?
Do I? You know, yeah, right. So that's correct. Yeah. So for those of you that are new to our quarterly market outlook, what you'll find is that we're going to spend the next hour or so going through all the relevant economic data points that we can find, where we are looking for information about where we're going economically, where we've been, use historical context to then bring that information to present day to say, well, what should we be doing with portfolios? And we're giving you an inside look to our insight. So, you know, some of you may be wondering, like, well, great, so what have you done and what are we doing and where are we going? Because what we also realized in this process is that there is just an inordinate amount of data and of newsletters and websites and all of this stuff, and we want to provide clarity amidst all the clutter, because we have nothing to position only just, you know, again, how are we going to best grow, preserve capital for your money. Yeah,
Sounds great. Let's dive in.
okay. Geez, all right, let's go. Okay, I'm going to share my screen here. All right, wonderful. Market outlook. Here we go. In action. So we've got 10 different areas to cover. And again, if you want this market outlook, we're happy to send you the PDF version. Just please drop Josh a note in the chat, drop us an email afterwards or whatever, or your InterOcean contact, and then we're happy to get you our latest. And we also just came out with their December performance numbers.
Correct.
If you want those, we'll send them to you too.
Sounds good.
That's right. Okay, so in terms of the 2023 performance, interesting, because when we started the year in 2023, the prevailing thought was recession. And it's interesting. So we didn't get a recession. And not only did we not get a recession, but the market did quite well. You know, the market got walloped in 2022, down 18.5, and bonds down 13. And what a rebound that we had, and if you look here, if you look in the middle, we got the kind of the second half performance, but really it was all in the fourth quarter.
Especially the last 2 months of the year.
Yes, and we've got a lot of data on that,
Yes.
but that was really it. And so you don't, and this is again, you never want to try to market time, and this is a case in point why. I mean, this fourth quarter, this chart, this chart, whether it be stocks of all kinds, higher yield bonds, regular bonds in purple, even alts, everything performed in that fourth quarter, really November, December.
It did. And again, like, you know, we're calling it the everything rally, and we do have a few more slides on that. It's just across the board. Everything just was feeling that excitement that, you know, the recession that we were all talking about never happened, and it will probably never happen, and we're fine, and there are so many things that are now completely under control, and there's nothing to worry about. It's upwards and onwards from here was kind of the—
What a relief.
Yeah.
I guess we're good. Should we end the call? No, but that's right. But that's what
that
happened.
was the sentiment.
In the sense, and then so in another representation of that, we're in interest rates, and we'll talk more about that and how that interrelates with the market and the market performance. So we'll try to, in addition to covering the information, give you some educational perspective. So if there are also things that we're saying, you say, well, what exactly does that mean? Another good thing to hit Josh within the chat, because Bhavin and I do the best we can to break stuff down. But you know, if you need more information, please let us know. So here's your everything rally. And you know, we did have some folks. We had some folks that were heavy cash. And
we're leaning in that direction. Again, I remember having these conversations with some of my clients saying that, you know, money market funds are paying roughly around 5%, treasury yields are hovering in that range, and that 5% sounds really good. And, you know, it's probably what all I need, and therefore it's okay. I don't want to go through the stresses of being invested in riskier assets. And a lot of those conversations at that point were also, from my point of view, were that if a risk-free asset is offering in something in that range, the riskier assets just feel that pressure too, and have to, you know, deliver more than that risk-free rate. And again, no one could have predicted the disparity between the risk-free returns and the riskier asset returns that could have been in 2023. But here is a chart that actually shows you what widespread disparity there was.
Yeah.
Especially, you know, when we look at the last two bars on this slide, you know, the tech stocks in general had a very, very strong year, knowing very well that, you know, 2022 was quite a struggle for those tech stocks too. So, you know, you kind of have to keep that in perspective too. But the Magnificent Seven, you know, that's been the talk of the talk of the street. And look at, you know, the average returns there. It's just phenomenal.
Yeah, I mean, it's one of those things that, you know, thankfully and gratefully, we had significant exposure to the Magnificent Seven in our portfolios, thank goodness. Because that's where the concentration of returns was, as you said. And, you know, with the market up 26%, that is not an insignificant return, but my goodness, was it heavily tilted towards that. We'll talk more about the 2022 decline and the rebound and what that means. But cash, which looked good at one point, was just, you know, turned out to be in huge difference in terms of its performance. And this is another way of looking at how concentrated those returns were towards the end. And the 60-40 or stock, 60% stock to 40% bond portfolio, November and December up 12%. Stock only, the S&P 500 up 13.7, November, December. Bonds, as interest rates collapsed, because all of a sudden this overwhelming feeling that the Fed was going to be cutting rates massively in 2024, Bonds go up 8.5%. So what was looking fairly ugly in October has had a very sharp reversal, all based on the Fed and interest rates. And that is a big concentration in the rest of our slide deck, which we'll get through. One of the things that we would want to talk about together is here this kind of whether or not there's so many people that are flooding into the market that it's overvaluing stocks. Has the buying gotten out of control? And Bank of America does happen to have a pretty good, pretty broad study of this information. And what you see is that no, this is indeed not like a top in terms of how many people are flooding into the stock market. You see, we're still above kind of that baseline average, but we're nowhere near, kind of like these historic buy signals. So I'm not seeing anything in there in terms of stock ownership that's alarming. So we can't get much from it. We always look at these data points hoping we could get something, but there's not much there.
Right.
And when we're looking at the concentration though, in the top 10 stocks, Bob, that's where you see it's like, there's just such a concentration now in the Apples, the Googles, the Microsofts, the Amazons, and clients are coming to us all the time with low basis stocks. And I find, I'm telling you, it seems like it's 1 out of every 2 or 3 new clients are coming to us with these low basis stocks that are requiring us to do these covered call writing positions for, which is just a very different dynamic than you'd see in other markets.
True. And it kind of also, the conclusion I would want to draw from this segment is that it kind of is interesting to note that the frenzy kind of feeds itself. It kind of becomes a self-fulfilling prophecy at some point, wherein the big tech stocks, the Magnificent Seven, which is driven by that AI frenzy, which was driving, as you could see from the chart on the right, which is driving a lot of people to create more concentration in their portfolio. So again, people are getting more and more driven towards that thought, saying, what's the takeaway from 2023? If you had a very heavily concentrated big tech portfolio, you had a great year. Should that be a strategy worth considering ever? No, but 2023 proved you wrong. For someone who only had 7 stocks in their portfolio, hands down crushed it, outperformed every benchmark out there.
But I wonder what the number is going to show if you owned in the past 2 years.
Correct. That would change things significantly. And we do have a slide on that which does show, for example, there are 4 tables that you see. So there's a little bit of a data to get through, but let's start with the first table on the top left, which again talks about the average Mag 7 returns last year was about 111.7%. That compare that to a 26.3% for the S&P 500, which is still pretty impressive. But again, look at that dispersion there. And the chart, the second table, so we move, we're moving from left to right, still staying on the top of the slide, is showing you that quarter on quarter basis, a significant amount of that S&P return was being derived from these Magnificent Seven stocks. For example, in the first quarter and the second quarter was where most of that, concentration happened. In the first quarter, the Mag 7 return was actually 103% of the S&P itself. Same story kind of continued in Q2 as well. Yeah. We did see the fourth quarter showing a little bit of a market, breadth widening. So there were more things that were doing better, not just these Mag 7, but we still ended the year with almost 83% of the S&P return coming just from these 7 stocks. So again, the key story last year was concentration. But to Michael's point, if you just zoom out a little bit and look at, what these, what these indexes have done on a 2-year horizon. So now we're looking at the fourth table on the bottom right there. Look at the S&P 5 return over a 2022 and 23 timeframe on an annualized basis. It was not as impressive. It was about 1.7%. And the small cap stocks and bonds actually really struggled over that 2-year combined period. So again, we're being highlighted with, a really stressful 2022, an amazing, at least on the face of it, an amazing 2023. But when you kind of look beneath the surface, it isn't that impressive. And another data point within this table is also, what if we
Yes.
actually also paid attention to trying to adjust these returns with inflation and see, okay, on an inflation adjusted basis, how impressive were the last 2 years? And you just come back with really, really disappointing numbers, both for, across the board, as whether it's S&P 500, Dow Jones, small caps, or bonds, the numbers were ugly.
We just want to have some perspective. Hey, can I highlight the energy thing?
Absolutely.
Can I? So yeah, we got a couple things, by the way, thank you for the questions. Keep them coming. Josh is there. He's sending me messages, which is wonderful. The question is, we can't get into specific sectors or individual stocks, take too long, but broadly speaking, we are aware that energy struggled last year, and utilities as well. You can see it demonstrated on the chart on the bottom left. And for that reason, there are certain parts of the portfolio, certainly some of the ones that we have in Arizona, where we are focused on energy distribution and energy companies as well, because we do see some opportunities there. We do see a pretty resilient price for oil, especially given everything that's going on in the Middle East with some of the consternation there.